Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have our EIA show today, and there's obviously a lot to talk about between the OPEC cuts, between the new OSPs going higher. What is Russia doing? What is Saudi Arabia doing? How are other countries going to interact? And really, what does it mean? So we're going to talk about that mostly in segment 3, just because that's our international section, and we want to keep it true. So in the first segment, we're going to look at, U.S. reports, draws across the board. Holistically speaking, the numbers were pretty good. We want to look at what was the driver of it. Is the demand going to start to come back down? Because again, we're coming into Easter weekend, then we have spring break next week, and there's a lot of pieces that come into that in terms of travel. So we normally kind of get this bump, but what is it going to continue, or are we going to get some of a drop down, especially along seasonal lines and economic? And then the next that leads us into the second segment of we got another seasonal bump, but what comes next? Like, is this something where it's going to fall, it's going to kind of flatline, and we want to look at some of those interactions, especially on the diesel side. And then in the last segment, we're going to go through those OPEC plus cuts. Why did they cut it? What are they looking at when they're cutting it? Is it off of production? Is it off of quotas? And then how does the raise in OSPs really impact things going forward? So with that being said, we're going to jump right into some of the data from the previous week. So here you can see total oil and product stocks. The surplus narrowed from 49.3 to 42. So yes, the U.S. continues to be on a downward move in terms of storage, but you're not seeing that in a lot of other places where you're still seeing a lot of elevated storage, mainly also in Singapore. And then again in Europe, when we start looking at gasoline specifically and light distillate across the board, but you're also getting increases in the middle distillate side. And the big driver of that is Russian product getting moved into the market aggressively. They're hitting 3-year, 4-year highs, and they're only 3 or 4 year highs because there isn't as much data going back. So realistically, we continue to see additional drops, additional increases of Russian flow. Total crude stocks land in floating. The surplus narrowed from 46.3 to 41.2. That's actually going to reverse higher just because we have more in floating at this point, and it actually is higher than the land side. So we will get some of that moving over. But one of the key pieces that when we look at the two on the crude and product side, there's enough back and forth where it's just going to go flat, and you're still going to be above what is deemed as the average. Looking from 2017 to 2019 and 2022, it's going to be right around the average, above average from that perspective, with the total oil product stockpiles, with the surplus narrowing from 3 to 0.8, with the product stockpiles again kind of following that trend. And a lot of that is being driven by light distillates and gasoline already being elevated, but you're getting a little bit of that follow-on based on the new middle distillate flows coming from the Russia. Now, some of the key pieces when you start looking at OPEC plus, we'll try to pepper in some information throughout, but a key marker, which is the Dubai crude market, which is really the benchmark, it leapt higher after the Saudi-led decision and the fact that you had some of these drop downs. So the most active time spread for Dubai swaps jumped to over $1 a barrel into backwardation and is now actually outperforming the Brent curve. Then we're going to have a chart on that looking at the disconnect between the two in the third segment. So now we look at total land storage, the flip to deficit from plus 1.4 to minus 7.4. That's something that is going to kind of follow that trend. And that was one of the things that we have been saying on the land front, is we just think it's going to follow that gray line, which is just the average. So when you look at 2016 to 2019 and then 2022, excuse me, that is the average number, and that's likely where we're going to be. When you look at west of Suez, the surplus narrowed from 11.5 to 2.4, again, just hugging that average line. With east of Suez, the deficit narrowed from 10 to 9.9. But when you factor in China, you're actually seeing a bit more of an increase, which is something that we're seeing on the floating storage side. So total floating storage, the surplus widened from 34.6 to 39.5. West of Suez went from 9.1 to 11.9. A lot of that is driven by both the U.S. and West Africa. And then floating storage went from 16.5 to 20.1 in the east of Suez. And that's what we were talking about with that Middle East and the China Asia front. Now it's interesting because the Middle East continues to see this push higher in terms of what is in floating storage. So when you look at the decision, you have to say, it's like, all right, were they looking at floating storage? Were they looking at where demand is heading? And they're saying, look, based on this floating storage, based on demand, if we want to keep ourselves, let's just call Brent between an 82 and 87 range, realistically trying to hug that 85 line, you're going to have to reduce production. And I think that was the biggest driver. But again, the goal is for them to keep it at these levels. And that's something that we've seen them defend on countless times. And the question is, what does this do to inflation? What does this do to rates? What does this do to economic activity? Because it's obviously, it's expensive when you look at where the economic backdrop is. And again, that's where that back and forth, which we're going to flesh out a bit more in segment 3. Now you look at the crude draw, you had a drop of 3.74. That's 13 million above the 5-year average, and the being above that 5-year is really again being driven by pad 3. When you look at the pad 2, small drop of 410,000. In Cushing, small drop of 970,000. So again, you're seeing some of those move downs in the Midwest, but you're starting to see a bigger increase of imports from Canada, and that's something that we think is going to trend higher, with pad 3, essentially driving the drop of 3.23 million barrels coming out of storage, and a lot of that is just imports did increase, but you had a massive export number that came through. Now, when you look at the supply adjustment figure, it's still elevated at about 918 when it's down from where it was. And as we're at the front of the month, we should start to see the export-import blending side start to clear itself. So over the next week or two, we should see that drop down considerably before it starts to move back up, because typically some of the biggest increases come at the end of the month, where you have a mixture of timing. And a lot of this is timing delay between imports, exports, filings. And that data is really only collected on a monthly basis, even though they try to project it weekly, resulting in some of those elevated numbers. And then obviously the blending side is hard to calculate until you see it show up in storage and get reported. So again, there takes time for some of those movements in general. Now, when we look at the at pad 3, here you can see that we're still at the third highest. Do you normally start to crest and move down? It's outside of obviously 2020, where you just went straight up. This is where you normally start to see that drawdown, because you have refiners coming back. We're in April 5th. You're going to see more activity as guys start to come back online to try to prepare for winter, summer driving, summer blends. And we still have a fairly good diesel market when you look at the storage side, though we do think that diesel cracks are going to come under more and more pressure. So then when you look at Cushing continues to fall. This is something where it drops down, and then we should start to flatten out for about the next 2 to 3 weeks. And a lot of that is going to be a mixture of, again, a bit of an adjustment on the export side and just more product coming down from Canada, which will level us out right around these levels. Now, when you look at runs had a small drop of 70 basis points, went from 90.3 to 89.6. You kind of waffle back and forth until we get more of a steady increase, which is likely going to happen. You had some slowdowns in Europe. Some of that is coming back following the protests. And then you had a bit of a slowdown in pad 3 of 206,000 barrels a day. That will reverse a bit. So again, we're going to be on a general increase overall as we go through, as we continue to see some of those increases going from that 90.3 down to 89.6, and likely, not so much spring loaded, but likely getting to 91% over the next week or two. We'll have a little bit of a slowdown next week just because we have Easter, we have spring break. a broader spring break. So again, those will impact some of the underlying flows. But again, 91% is very much in the norm when you look at previous years. Typically you could get one little drop down. You could see it's happened previously. You get a little bit of a run, a bit of a drop, but we're right in that normal utilization rate, which is why we think we're going to kind of hug between that 89.5, 91 number, but moving a bit closer towards 91 versus 89. Imports, big increase of 1.81, essentially 1.8 million barrels a day. That's 514,000 above the 5-year. And it was driven by Pad 1, Pad 2, Pad 3, seeing sizable numbers. And some of it is a makeup. As we said with Pad 2, there was an overreaction to the downside, overreaction to the upside. Not surprising here. That reported an increase of 896,000 barrels a day. Again, it's going to stay above the 5-year average. You're going to see a lot of that pull down, especially given where we are in Pad 2 and the flexibility we have in that area. And then Pad 3 had a sizable increase of imports of 548,000 barrels a day, but that's still below that 5-year average, which we think is going to level off as they try to balance those exports, imports, and they try to get a bit heavier heading into that summer driving preparation time. And then Pad 1 remains lumpy, with Pad 5 staying fairly consistent. Then here's just looking at Pad 3. As we were saying, it was going to move much closer to the 5-year average. We just think it's going to now stay below the 5-year, but again, within the lower end of the cloud, but just stay a bit closer as you get more of those refiners coming on. There's some decent opportunity to pick up some discounted West African cargoes. That's likely going to help out, especially given what has been done by Saudi, by the Middle East. We should see some additional flows coming from West Africa into the U.S. and Europe, especially as Europe comes out of some of their strikes. Here's the chart showing that big spike in Pad 2. On an import level, as we were saying, it's going to average to above the 5-year average. That's where we think it lives. So it'll drop back down within the cloud, but again, just stay above that 5-year. And when you average it out, you can see that we still continue to see elevated imports from Pad 2. Implied demand had a nice little bump. Finished gasoline had another increase of about 150,000 barrels a day. Went from 9.14 to essentially 9.3. Now, typically when you look at seasonality, you either have two periods of increases and then a big drop, or one big increase, a small drop, and then a little bit of a bigger drop following kind of that pre-buy ahead of Easter, ahead of spring break, and then that lull, and then you get a little bit of that lull for 2 weeks, and then you start to see a steady increase as you get that pre-buying for Memorial Day weekend. And again, that can always vary based on where Memorial Day falls. And especially how late is Easter, how early is Easter? Like last year, Easter was I think it was pretty late last year, and that again is going to throw off some of the seasonality, but that's just the kind of a normal piece. So we still think that we're lower on an actual consumption basis. Let's call it 8.7 to 8.8, just based on numbers, and we'll show you what that looks like from a tom-tom level and why we think we're going to be there and kind of settle out. Distillate fuel oil had a big increase of 527,000 barrels a day. Again, a little bit of that is more of a makeup number, just because things were a bit lower. You have that big push ahead of the holiday, making sure the diesel's available. But again, we don't see a huge increase in demand. If anything, we actually see trucking demand getting worse, and we'll go through those numbers in the next segment. Jet had that increase of 247,000 barrels a day. Very normal given the increase in flight schedules, increase in travel for this period. So nothing too crazy, with propylene increasing 210,000 barrels and bringing us right in line with the 5-year. When you look at that implied demand for gasoline, this is what we're talking about, where you normally kind of get that spike, and you can see that Easter is typically a little bit later, and you actually had, there's two different avenues where you have a little bit of a bump, then a bigger spike, and then that drop off. Here we had two sizable increases, and as we come into next week, we'll get that move down. And typically it's a sizable move down. Then you go sideways for 2 weeks, for 2-3 weeks. And then you start to get that nice little grind higher as you get additional people demanding product, pulling product forward for that Memorial Day driving period and really the kickoff to summer driving season. Oil inventories, excluding the SPR, came down, but you can see now is kind of the point where you start to see that pivot. Obviously, 2020 is slightly different, but you're still in a fairly comfortable level when you look at the commercial market and the commercial backdrop. When you factor everything together, commercial oil storage, you're coming into a fairly normal period when you look at against 2018, 2019. We typically start to come down, and then, as we were saying, you level off a bit, and it's because you have a bit of a lull between spring break and Memorial Day weekend, where people go out, they obviously go on vacation, go see family, and then you have kind of a slowdown, and not by no means a big slowdown, because it's spring, people are doing sports and people are outside, so you don't re-rate back to where you were prior, but you have a bit of and then you get that grind higher, and that will take us into Memorial Day weekend. Days of supply, again, very comfortable given where rates are. Gasoline storage, it's moving along seasonal levels in terms of the rate of change to the downside. It's just you started much lower on the gasoline storage side. And a lot of that is being driven by the problems of getting gasoline from Europe into the U.S. That is driven based on cost of getting it over, and that is keeping us down here, especially given where refining activity is, and just some of that pretty aggressive pull through, which is why you get, again, you could see it in these numbers, you get that steep drop, and then you flatline until you start to get to that Memorial Day period, and then you start to get some of that demand, and then you see that sizable drop as we go into the peak summer driving, which is July 4th to the first week of August. That's that 5-6 week period is peak demand even for summer. So let's call it peak of peak, because summer driving season is peak, and then the peak of that is that July 4th period to the first week of August. So distillate storage had to move down. You can see that there's seasonally speaking, there's usually one more drop, and then you'll start to see it level off. It's just, as we said, similar to gasoline, we just started lower. So that drop is seasonally normal, just at a much lower level, which is why we still remain well below average. Jet continues to kind of manage that difference between where are we on the distillate side, where are we on the kerosene side. That's going to continue to be the case. Here you can see we had a nice move higher in the curve, and it's on the front month side. You were back above where we were when you look over the last 3 months. Now there's two pieces to this. One, you now have the U.S. being included in Brent. That is in the Brent, I should say, the dated Brent calculation, which will be a benefit and kind of close the gap a bit between where is Brent and where is WTI. But you can see that on a curve basis, we're still there. And when you look at contango, it's starting to flatten out. You still have slight contango, but you're starting to move further and further into backwardation, which is just meaning that you're getting some of that demand pull through, which is a net positive when you think about pricing. But as we've been saying, we're now back in the previous kind of trading range with WTI moving much closer to the highs. Then when you look at Brent, we're between that 82 and 87, with really trying to hold that 85 to 87 line. If we can't retake that 85 in a meaningful way, Brent will likely settle closer to 82, 83, but still, again, well above what the quote-unquote OPEC put is, of which is 70, 75, depending on who you ask. And that's going to be the case until we get a bit more of that demand destruction. We had that sizable increase in floating storage in the U.S. started to drop back down. We do see more of that increasing just because of some of the purchases that have happened. But you can see we're just going to stay right around the average, so nothing too crazy there. And it just means that we'll get some additional imports into Pad 3. So that's what we have for you on Segment 1. In Segment 2, we're going to go deeper into the U.S., what is happening with flows, and what do we expect to happen going forward.